Welcome back to the Australian Retirement Podcast, your source of retirement goodness every Thursday. I'm here with Drew Meredith, as always. Hello, buddy.
And what a time to be alive. How are you?
Isn't it just? Yeah, I'm really well, thank you.
It's been a few weeks for us.
It has. Yeah. I was saying before that I got absolutely walloped by the flu and spent 3 hours on my feet.
I thought it was early retirement for a minute there.
Oh, yeah. If that's what retirement's like, I don't know if I want to be part of it. It was horrible.
There's probably an episode of that too. Babysitting of young children, it's usually where their sickness and illness come from, and babysitting leads to flus, leads to all number of ailments.
That's exactly where I got it too. I was holding my sick little boy, and I thought to myself, I might get this. And I was like, no, you just got to just do the right thing, look after him, you'll be fine.
Not good at catching the old cough.
Narrator, but he was not fine. Yeah. Oh my Lord, it was terrible.
And I can confirm I did speak to James on Tuesday morning, I believe it was.
Or someone that sounded like a very sick version of me.
It sounded like death warmed up for 100, for sure. It was not the man flu.
It wasn't pretty at all. We got heaps to get through, and today is a really big Q&A session. Lots of great questions, as always, to all those people sending through questions. Thank you. We are incredibly grateful that we get them, and we get some wonderful feedback, and we get some wonderful suggestions for content too. So lots and lots to do. Quick side note: one of the horrible ironies of being unwell last week is that the episode that got released was around health and longevity, which I recorded with a doctor. And I was like, okay, well, this is a good time to dial into this.
Yeah, clearly didn't follow this.
All right. So before we jump in, we had a really meaningful change not too long ago, which is interest rates, right?
One of my favorite topics for people who've listened to the Australian Investor Podcast. I have a pseudonym over there called Andrew Derrimouth, who is predicting interest rates would be cut for close to 18 months. They actually were increased during that period of time. That's why it's a pseudonym and not me. But it was a big week last week.
Because you were finally vindicated.
Yeah. Well, I actually said that I give away a free book to every listener if rates, a book copy of the Golden Years, not just a random book.
So a good book.
Hopefully a good book. If rates weren't cut before Easter, and it was getting very close. I reckon I had one meeting left of me before rates were cut, but that was a certainty. I think the yield curve would predicted 90% probability like it had before.
Yeah.
I wasn't nervous at all.
All right.
But it was huge. What does it mean for retirees? Have you been inundated with phone calls about falling interest rates? What do I do with my term deposits?
Yeah. Well, this has been a really weird time for our business because we've got a lot of people who are still in the accumulation phase. The majority are accumulators. And so most of those have mortgages and have debt and so on. And they've said, oh, that's great. What does that mean for me? And hopefully more free cash flow and so on. And then we've also got the cohort of people on the other side that have, whether they're retirees or alternatively, there's just ahead of that on the accumulation curve and they don't have the debt anymore. And they're saying, what does it mean for me? And it's negative. So it's been an interesting situation. There seem to be very few disaffected people in the middle.
Yeah, it's had an impact on everyone. Cash rates are falling. Everyone was comfortable holding cash and term deposits. And then you get a reminder. So I looked at it and I think we've talked about it before, that a drop from 4.35 to 4.1%, that's a 6% drop in the income you're getting. And that can be pretty significant. But we could be clickbaiting and say it's an incredible change that'll, change the outlook for the next 12 months. But really, unless there's a significant shift down in interest rates, it's hard to see it having a major impact. It's nice relief, I'm sure, for mortgagees.
Yeah. I think that's fair to say.
Yeah. Like you're not throwing out your portfolio tomorrow to readjust as a retiree.
Having said that, I reckon we're going down again. And I think that we may very well be going down.
This is a prediction. Yep. Can we bring Google or Amazon?
But I'm not promising a damn book for every person if I'm wrong.
I'll promise a book.
I think that there is a higher likelihood than not that we will see another rate cut within the next two RBA meetings.
This is the hard part because before you got in here, me and Owen were like, is there an RBA meeting today? Because it's the first Tuesday of the month.
Not anymore.
No one knows when the RBA meetings are. One of them was 2 weeks ago. I think it was the 17th of February, a 2-day meeting. So it was incredibly confusing. I think there's only one meeting before Easter.
Correct.
Yeah. And then who knows the rest of them. So I have a similar feeling. And I think initially the notes came out along with the RBA rate decision, and it's the governor was heavily kind of saying that they almost were very close to holding it, but then the deputy governor came out more recently and was saying that it's clear that hasn't released the restrictiveness on the economy yet. I mean, what you're ultimately saying there is people with mortgages have still got a massive portion of their income going towards servicing their mortgage and they can't spend it. and inflation's kind of coming out as expected now rather than surprising to the upside.
Yeah.
And I'm always talking to, I tried to do a bit of it wasn't clickbait, but a bit of video that'll come out shortly as well. And I think when things like these change, you shouldn't be throwing everything out. You should have had a plan, or hopefully your portfolio has been built to sustain different environments and different outcomes rather than just one. That you don't have to rethink everything all of a sudden overnight.
Now, in the midst of all this, we've also saw some pressure on the banks, which was relieving because my bet looked really ugly for a little while.
My second favourite topic.
We said 155 for CBA share price. That was our line. At one point, it was up in the 160s, and I thought, I'm in a lot of strife here. It then pegged back to 150s, and I can't tell you how much I was looking forward to that podcast that we were going to run.
What do we bet again?
Dinner.
Oh, yeah.
Because I was really going to stick it to you. I mean, if you choose not to stick it to me when the share price is in the 160s, that's your decision. But when we go down into the early 150s and 140s, you're going to pay the price for that. And but unfortunately, it has since rebounded back to 157. So this bet is
151. Yeah.
I mean, this bet is well and truly live. So.
Is this for the whole year?
It's a season-long
some
bet.
sort of AI reminder. I seem to not be able to keep up. I'm making quite a few of these wagers, let's call them, with Owen on the Investors podcast. I tend to be on the wrong side of them most of the time.
Yep.
It's still the biggest topic in markets at the moment. Where's CBA going? Alan Kohler came out with a video, I'm sure you saw that one, that said it's the most expensive bank in the history of the world, or something very similar. And I mean, if you look at very basic historic approaches to valuation, like a price to book, which we could be going a bit too much detail, it is expensive. But are there banks like the Commonwealth Bank in other parts of the world that have such high market share, that have such good deposit funding, and ultimately, as far as I can understand, CBA only really lends to people who can afford mortgages these days. They're not, taking massive risk in lending a lot to development or to people more with higher loan to value ratios either.
Stop trying to convince everyone.
Okay. Talking to a CBA and an interest rate bull over this side of the table. Is it overvalued though?
Well, we've already spoken about this. If I thought it was at 155s, it is at 157.
We'll take it.
Okay. All right. But nevertheless, you are in the lead.
It's a tough one, yeah.
Q&A, we got lots of brilliant questions. I really enjoyed the last ones we've done where I don't have a damn clue what question's being fired at me. So we're going to stick with that model. Let's get started. This one is for you. The question is from Big Ice Cream. Hello, Big Ice Cream.
There's no underlying link to anything for that? No,
look, there could be, but it's beyond me. Yeah. Well, everyone likes ice cream. My wife and I are 56 years young. I have 800K and my wife has 300K in super. We have our own home. Value is about $900,000. We have 5 investment home loans, about $1.6 million. It's a bit of debt.
I'm assuming they have houses attached to those too.
Yeah, I think that's fair to say. There's no reference of any investments, so we'll assume that there are investment properties attached to all those. 50-50, but cash poor. Oh, sorry. So the ownership strategy seems to be 50-50. So what's being conveyed here? They're asset rich, cash poor.
Yeah. And I mean, a lot of people are, as we were talking about with interest rates, $1.6 million in debt costs 3 times what it did to service 3 years ago.
Yeah.
So you're automatically going to be cash poor.
Correct. Even with the tax deductions, this is going to sting a lot. So can we put one investment home into a self-managed superannuation fund, and will it free up cash? Thanks, Darren.
I reckon there's a story about getting personal non-superannuation assets into super as you get close to preservation age of 60. But to answer this question, I'll answer the question first rather than going off on a tangent. So the sole purpose of superannuation is to provide an income in retirement. And there's very few things that are like specifically restricted in superannuation, but one that is you can't and then we're talking about a self-managed super fund. An SMSF cannot transact with yourself, the members or trustees of the fund, when it comes to residential property. So that's any sort of residential investment property. It can't buy a residential property from you. You can't sell to it, and you also can't buy a residential property from your super fund. The only close thing, I wouldn't even call it a loophole, the only type of property you can deal with yourself with an SMSF is a commercial property or what's known as business real property. And interestingly, business real property could be leased to your own company and be transacted in and out of the super fund. Not that you want to be transacting it too much.
So to be clear, this is not just a normal commercial property, but it's a commercial property from which you operate a business.
Exactly. Yeah. And this is kind of where the original idea of self-managed super funds came up, which was to allow small business owners to own their premises, pay themselves rent, and accumulate wealth outside of their business. But it's basic. There's a flat restriction on dealing with residential property for yourself. But there's also the considerations of putting one investment home into your self-managed super fund. You've got to deal with not that you could do it, but there would be contribution caps. There's going to be likely to be stamp duty, and any transaction with your super fund, even if it was commercial property, is going to be a capital gains tax event as well. So it's not without costs or without risks, but you cannot put a residential property. You can't deal with a residential property with your SMSF. I think it's a good story here, though. So as we know, once you reach 60 and cease some sort of employment, you are able to start accessing your superannuation benefits. So you're actually not too far away from that, but you clearly have probably, I'm just guessing that maybe it's 50% equity, then you might have $3 million worth of property and $1.6 million worth of debt. Let's make a very broad assumption. You clearly have a significant amount of assets, and more than half of them are outside super. Our aim as at Wattle is to have say 1/3 outside super, 2/3 in, or if possible, get 100% of your money into super. But you have a long time to do it. So you can't access until you're 60, but these days you can actually continue to make contributions until you're 75 as well. And as we talk about, and I'll cover in another podcast we released in a few weeks, your retirement's likely to last anywhere from being 95 to 100 years old, based on, if you make it to 60, then it could be as long as 30, 35 years in retirement. So there isn't as much rush in getting money into super. Yes, there's tax benefits, but you have plenty of time to be able to do that.
Yeah, I think that's fair. I'd also just add here with that you obviously cash poor. This makes perfect sense. Serviceability alone on that 1.6 million of debt is going to be important. But if you haven't already, potentially speak with your accountant about the idea of a tax variation. So as a reminder, we've spoken about those on the potty before, but the idea of tax variation is that if you have if you consistently get very high tax refunds, and often that would come by, for example, having really high deductible debt, like 1.6 million at 6%, or that's $96,000 of interest. Yeah. And realistically, you're going to be paying more than 6%. So you're going to have over 100K of deductible interest here on those loans. If that is the case, well, then it's very likely you might be getting $30,000 to $40,000 a year just in refunds. A variation would allow you or your accountant to sign off to say there is an incredibly high likelihood that this person is going to get let's keep the number simple, $36,000 a year in refunds, $3,000 a month. So therefore, what we're going to do is we're going to adjust how much income tax is taken from this person's salary so that they get $3,000 more income every month, to negate the fact that at the end of the year, we're expecting a $36,000 tax refund. And it's perfectly legal. You would have to pay your accountant to do it, but as far as I'm concerned, it's really nice to get that lump sum of money at the end of the year when you do your tax. But if you're describing a really cash poor situation here, you may very well be better having the money up front.
I think that's a good reminder, because people think, getting a tax refund means they're paying less tax. It actually means you've paid too much tax during the period and you're getting it paid back. And you kind of generally don't want to be paid a refund, because it means you pay too much. The government's had it, whereas you haven't. You kind of want tax payable that you have to pay at the end of the year.
Correct.
So I think that's a great reminder. And yeah, it is. I mean, when it's coming from salaried income, and then you can obviously vary PAYG if you're under that. That's usually distributions from other places though. And we'll sneak on to the next question. One for James here.
Come at me.
Titled, the question that comes from Learning As We Go. Thank you for the great new retirement podcast. Oh, where's that? Along with the investment ones, we are regular listeners. I was very interested in this week's topic around 5 health issues, and it is obvious Stephen is passionate and well-researched. Obviously, time limited the podcast, but it would be great if you could do another, this time focusing on what we can do day-to-day to minimize risks for these 5 areas. Thanks in advance. Trying to be financially and physically healthy oldies. There's some lovely feedback from your session with James. It wasn't. I think you had you nervous that it was actually a question there. So really sold that one really well.
Yeah, I was like, here it comes. Just listen very carefully, and it was just some kind words. Yeah, absolutely.
I thought, is there a Northeast Wells Cross Rask water aerobics calisthenics
there
video
should
on the
be,
cast?
shouldn't
Yes,
there?
I think so.
Absolutely.
We can't. You can't talk about it and not do it. So I feel like you have to.
Yeah, this is a ripper idea. Yeah, I can see this one. No problem. We want this podcast to be as valuable as it can be, and I think it'd be a great idea to go through some detail and talk about how do we reduce these 5 areas. As a reminder, we were talking about things like cardiovascular disease, dementia. We were talking about cancers. The major things that pre-retirees and retirees are likely to be affected by when we talk about health issues. So wonderful idea, and absolutely we'll have Stephen back. Similarly, I thought he was he's a really switched on individual. He's very passionate. So yeah, great suggestion. We'll make it happen. I'm
also looking to get a colleague of mine whose husband has dementia, I think early onset, and kind of potentially interview and walk through what it's like living with a partner with dementia as well. I thought might be somewhat interesting and kind of insightful.
Absolutely.
Now to the real question. This one comes from Silver Surfer. I am 62, retired, and have been utilising my super income stream with a current balance of 1.4 million, withdrawing the minimum required 4%. I've added $250,000 as a non-concessional contribution, which leaves me the option to add another $110,000 under the bring forward provisions, $120,000 per year per person. I have no other investments. My partner is 54 and still working, so 62 and 54. She is selling her home and will buy a half share of my home.
Goodness.
I will then have around 600,000. I mean, the specifics probably don't matter as much. I would like to use the downsizing ATO option and add $300,000 to my income stream. However, I do not believe I would qualify. So that's the first question is, can I qualify? How do you qualify for the downsizer? What is the downsizer contribution? How do I qualify for it? How do you add it to your income stream? And then the follow-up question is, should I create a new accumulation plan in super or look at term deposits or bonds? Thank you.
Here we go.
I tried to break it down into 3 to 4 questions.
Yep.
And this isn't the longest question we've got today.
Thank you for psychologically preparing me for the next one. Okay, get a Silver Surfer. Okay, so
a note to the comic book.
Yeah. There's a bit going on here. So from the top, 62, super balance is 1.4 million. So then, yes, you are able to make more contributions in a super. If you've made 250 as a non-concessional contribution, of course, then using the bring forward rule, the max you can do is 3 years of current. Yep. Current's 120, so the max is 360,000. So yes, your gap is, or your delta is 110. So all clear with there, and that means, of course, that you could conceivably put 110 straight in. I think you already know that.
I'd assume they've done it this financial, like 24, 25, they're saying recently, which means that's why they're probably looking at the downsizer. Yeah.
Sure. Yep. Okay. Partner's 54. So firstly, if your partner is 54 and still working, when she sells her home, you're not eligible to make a contribution under the downsizing option. The superannuation downsizer option is designed to enable Australians to downsize and release money from what typically for a lot of Australians is their biggest asset, being their home. And the system's pretty fair, I reckon. It enables people to sell their home or a place that they've been living in, and then use the proceeds of that to contribute money into the superannuation environment. It's not uncommon at all to find Australians who might have a very low super balance but a very wealthy home, just due to the fact that the home has grown in value over a long period of time. So this legislation enables Australians to take some of those proceeds and put them into super. Now, the good thing about the downsizer contribution is that the contribution amount is not included as a non-concessional, well, does not count toward the non-concessional contribution cap. It's still treated as non-concessional in the sense that there's no tax for the money to go in. You can do up to $300,000 per spouse. So that'd be $600,000 in total. And noting that, of course, with that concept of downsizer, if you sell most people like to be downsizing as they either approach retirement or enter retirement or in retirement. So you might have a property worth, let's say 1.5. We're going to find something smaller with a smaller block, single story. We don't need a 4-bedder anymore because the kids have flown the coop. So in that scenario, we're going to go to a much smaller place. It's going to be 1.1. And so there'll be $400K of differential we'll use that 400K to then put into the super fund.
And you can have over 1.9 million and still make a downsizer.
You can, that's right. So it is a really, really attractive system to put more money into super. Now, there are a number of requirements for you to put money into super via a downsizer. One of the obvious ones is that you have to have owned the property for 10 years.
Yep.
The second one is the minimum age, which I think is 55.
55
if I recall correctly.
It started off at 65, which was quite late, to be honest.
Well,
and 15 years.
Way too late. Yeah. So you've lived in the property for 10 years, and during some of that period, it has had what we call your main residence exemption. And typically that would mean, or that would be reflected by the fact that your driver's license would be directed there in terms of the address. All your post would be going there. You're on the electoral roll, that would be your nominated address. Those sorts of things would really clarify that was at one point your main residence. So assuming that you qualify under those terms, then yes, when the property is sold, you could then do it. Now, importantly, you don't have to be the joint owner of the property. It could have been a case that when the property was bought, maybe it was bought in your spouse's name because from a tax perspective, that was better, or you you made a mistake, asset protection, a whole heap of reasons why. That's fine, provided it was also your home. And we were looking at the ATO rulings the ATO guidelines for this a little while ago now, and I remember that it's a little bit opaque because it doesn't really dial into the idea that in order to make a downsizer contribution, it must have been your main residence at some point over the last 10 years. But to be clear, it can't just have been your spouse's main residence, it must have also been yours. So
the person contributing, yeah.
That's right. So if you wanted to circumvent this, the way that you would do it is that you would not sell your partner who's 54, don't sell the home just yet. You move into this home and make it your main residence for a period of 6 months, for example, or an appropriate amount of time, then sell the home, and now the option is available for you as well as your spouse. But without having taken that step, it won't be available. Now, there's one more little thing here that I've just seen. Here we go. It references that she will buy half share of your home. So just very quickly, if you transfer, or if your spouse can purchase a component of your home without stamp duty, and that's done under what we call the love and affection transfers. So it might be a case that Alice meets Tom. Alice owns all of her home. Tom doesn't own a home. They shack up together, they spend quite a few years together, and for whatever reason, they decide, hey, let's make this a 50-50 home rather than 100% Alice's name.
Yeah.
In that scenario, ordinarily, if Alice was to give Tom 50% of the home, Tom would have to pay stamp duty, or someone would have to pay stamp duty for 50% of the transfer duty. But there is legislation which is loosely called the love and affection transfer, which exempts at least certainly Victorians, but most Australians from paying stamp duty on that transaction, provided there has been no there's been no funds exchange hands, there's been no consideration for that purchase. So I share that because if the plan is for your spouse to buy half the share of your home, and then there's going to be consideration, and if there's consideration, then by my interpretation, that would trigger stamp duty. So
and capital gains.
Well, no, it's got a main residence exemption, so not likely. But nevertheless, the stamp duty is still going to be pretty reasonable at these numbers. Yeah. So it might be worth firstly getting some guidance, some legal advice around what the stamp duty might be, and then similarly, is there a way that you can get those funds from your spouse without it being part of the consideration for the property, and therefore you could avoid stamp duty, notwithstanding I'm not trying to avoid paying tax here, just is there any or let alone evade it, is there any practical way that this can be done to ensure that you don't have the stamp duty headaches? Yeah,
for sure. I think that's incredibly important points, because I know this is where like a lot of questions around advice come. This would be something we would help with clients, and from an ongoing, but as an ongoing client, something random like this comes up, and you help engage to find the solution. Because you can imagine if you're just trying to do this yourself and you didn't hear that or didn't know that, you could have just triggered 5.5% stamp duty on a $500,000 million house, or 50% of that, which can be significant, particularly compared to the cost of just getting advice on it from anywhere.
Hey, forgive me for hijacking one more tiny bit of this. Should I create a new accumulation plan, which was your last question, or look at term deposits or bonds? Assuming that there's there's no other ways to circumvent, like we talked about, and you're not eligible for Downsizer, then we're only looking at a couple of years until you can put the money into super. Obviously, we keep harping on about it and talking about getting money into super because it's so tax effective, and you get such flexibility with where you invest the money. It's so simple. So to that end, if someone came to me and said, look, I've got, say, $300,000 to invest, the plan is eventually that it will go into super, but I'm not doing it today because my non-concessional cap has been exhausted, so I've got to wait 3 years.
Yep.
We would typically invest the money as if it were going into the super environment, so that when the time comes that you qualify, we can just make an in-specie transfer and the money's always been fully invested. Now, the downside is, of course, that there might be some tax payable. A Silver Surfer said that they're retired, so therefore the tax should be negligible or quite low or nil. And so I think if we took that approach, yes, there might be a small amount of CGT. We could easily manage that by selling over multiple financial years, sell on June 30 and July 1 or whatever. And at least that way you're not losing out on returns over a 3-year period from being correctly invested versus just saying, well, if I can't have it in super invested, I might as well stick it in a term deposit and just wait.
Yeah, I mean, we apply a very similar approach too. And I think, and different advisors think in different ways, but if this is your consolidated asset base and this is all the assets you have that you're going to generate a retirement income from, it should just be treated as if it's one pool of assets. And then one thing we'd try and do is hold the appropriate investments in. If you do have taxable income, how do you make sure you're not adding to it? But in this case, it doesn't sound like it.
Yep. Okay. Oh, that was big. Okay.
I think it is interesting because one simple question becomes 3 follow-up questions, and that's retirement. Like, that's what I find, that it could be a simple answer, but as soon as we realize that's not the case, there's ways to still benefit from it or still get the most out of it or minimize your tax or costs in some way.
Yeah, agreed. This question
maybe that's just our analytical minds.
This is a classic example of Donald Rumsfeld's unknown unknowns, isn't it? Yeah. Okay. All right. I'm going to throw one at you, please. Which one? Simple Simon. Seems like a good dude, Simon. Simon's question: a full-time staff member of mine has just turned 67, does not own a home, so will be renting for the rest of her life, and has minimal in super. I suspect under 350K. I think she is afraid to retire due to her financial situation. What financial safety nets, such as the pension, are available to her that could be used in combination with her super that might give her more confidence to retire or at least work less? Simon seems like a nice guy.
It does seem super helpful,
yeah,
and friendly. I mean, this is probably one of the more difficult questions for me to answer because I don't have a lot of experience in this area. One thing I'd say is I'll say I don't have a lot of experience in this because I tend to work with self-funded retirees, but there is a broad spectrum of advisors, and there's people who could definitely help in getting into the detail and helping. Do we say, was there a name? We're calling her Sandra. I think did you say Sandra? Yep.
I did. I did not.
We're calling her Sandra, where they do specialize in the types of things I'm about to talk about, and it can be more approachable, less complex, and a lot more knowledgeable on the detail of what essentially there is a fairly good safety net in Australia. As a base level of income. So at 67, you gain access to what's called the age pension, completely different to a superannuation pension. Age pension is basically the safety net for people who didn't have the benefit of superannuation, haven't been able to accumulate for one reason or another enough assets to self-fund their retirement. So this is the government-funded retirement, essentially. Just starting with what do you need to get it, I think is probably maybe the better place to start is how much you can actually get from the age pension. So,
$1,100 a fortnight.
Yep. Oh, $1,047.10.
Okay. Beg your pardon. Waiting for the next indexation.
And then you go through the supplements. Yes, of course. I just have to be right sometimes. So for a single, yes, it is $1,144.40, including the energy and pension supplement for those that are on the maximum, which turns out to be times that by 26 is like $29,000 per year. And for couples, it's closer to $862 per fortnight.
Each.
Yep. So $1,720 per fortnight. And that turns out to about...
No, don't look at me with those eyes. That's about 40K.
Yeah, I was going to say 39. I'm just doing really quick maths in my head. So that's the ultimate drawback. And to be able to access that full, the pension does reduce. You're really enjoying watching me on this one. The pension does reduce based on either your assets or your income. So what might be an issue here is that Sandra, let's call her Sandra again, can't necessarily access the age pension because she's still working and still earning an income. So we need to look at both the income and assets tests. From an asset perspective, she doesn't own a home, so she's able to have $566,000 in assets. So her superannuation would be below that and get that full age pension. So she'd be entitled to a very solid level of, as we said, about $28,000 per year if she's single. If she did own a home, it's slightly lower at $314,000. That goes, probably to keep it relevant, that goes all the way up to, you could have $947,000 or nearly $1 million in assets as a non-homeowner and still receive a small age pension, which obviously not relevant in her case, but I think relevant for the audience as well. You do also have an income test, which is where the decision, and this is probably where advice would become valuable for Sandra, is to determine whether she's better off trying to put more money away by working, or if she is comfortable moving to rely on the age pension at some point in the future. So the fortnightly income cutoff point for a full age pension for a single is $2,500. James knows I'm not getting this off the top of my head.
You got this, yeah.
And for a couple living together, $3,822 combined, or $1,900 each. So you can times 26 times $2,500, 5, 13.
No, I'm not going to. I'm just loving it.
5 times 13. That's half. That's $65,000 a year. Done. Pretty good at that. And then naturally, we won't go into the full detail of that at the moment, but you have this, if you have assets that including superannuation, once you start drawing a pension from them, you have a deemed income that comes from those assets. But I think we'll cover that in a separate episode. So the biggest fallback, and this is just the specific answer to the question, is the age pension. And Sandra should be should be able to access it at 67 years of age. There are some little bonuses you can get out of that. There is a work bonus where you get some credit and a portion of your income not included in the work test, the income test for your age pension payment for a number of years. There are also things like the senior and pensioners tax offset, and probably one of the biggest things I see and the biggest value that people get in retirement comes from the healthcare cards that come with the age pension, or even the Commonwealth Seniors Healthcare Card for those that can't access the age pension. And these offer access to the pharmaceutical benefits scheme in Australia, which can be incredibly valuable. Sometimes for retirees that are self-funded, incredibly valuable in terms of the benefits they have. So hopefully I did the question justice. And interestingly, the most important thing you can do to start your process of getting the age pension is register for MyGov, which was also my number one recommended thing to do in 2025.
Yep.
So one of the most difficult parts, I've had members of my team going through age pension application. It is an extensive process. So there are firms that will help specifically with that task, and get help because it can take time, and you could be in and out of the office quite a few times as well.
Well done.
I think we got through there.
Well played.
We got through there.
We got time for one more?
I think we do. And this one's, I assume this is a reference to the jokes Owen and I were having on the Australian Invested podcast. The question comes from not Jason Day either, referring to the Australian golf player? Do you call it golf? Golfer. I'm really good at this golf thing at the moment. All right. Here we go. From not Jason Day either. I'd like to understand the mechanics of retiring. I expect to retire in FY26, March 2026. We're getting very specific, at age 60. So let's ignore the time. Expect to retire at age 60. Can I bring forward 3 years of non-concessional contributions on July 1, 2025? Officially moving from accumulation to pension mode in our SMSF? Do I mark to market the value of the SMSF on the day of retirement and calculate the value of my membership versus my wife's and declare that as my starting pension value? And question 3, and I'll reissue these for you as well. Will I need to draw down 1% of that value before 30 June, as is the requirement? 4% times 1/4 of a year. Okay. So 1, can I bring forward 3 years non-concessional contributions on July 1, 2025, assuming they haven't made any contributions before? 2, how do you actually calculate the starting point of your pension? And 3, what are the rules on the minimum pension drawdowns?
Yep. Yeah, sure. All right. Hello, not Jason Day either. So yes, it sounds like you can bring forward 3 years non-concessional contributions. So that'd be 360K, like I spoke about in the previous question. And the date, 1 July 2025, I mean, the date semantics in the sense that you're 60 years old, so there's no issues with non-concessional contributions at this point in your journey. So
not until you're 75, really.
Yeah, you've got plenty of time. So yes, you absolutely can do that. Moving from accumulation to pension. So what I can take from this is that you and your wife are both members of the SMSF that you own, self-managed super fund. So if that's the case, then there would need to be a valuation done on that date that the pension was established, or that we moved from accumulation to pension. And that would, amongst other things, determine the percentage of assets which are yours versus the percentage of assets that is your wife's. Now, that should be happening automatically anyway. Of course, if you look at any of your tax returns for your self-managed superannuation fund, you scroll down to the, let's say 2/3 of the way through, and you'll have sort of an individual page for your assets and an individual page for your wife's assets, assuming you each just have one accumulation account, which would be normal at this point. And then from there, from that, the percentage, and it will be with 2 decimal places, like 57.54 or whatever the number is, that amount will then be able to commute across to a pension. Now, from a reconciliation perspective, yes, you do need to work out what that value is. And the reason that you do is because you do need to make a drawdown. The rules with pension drawdowns, you've pointed out that you've written 4% here. So you're already aware that the minimum pension drawdown for someone under 65 years old that has an allocated pension is 4%. And so therefore, for the entire year, you'd need to draw down 4% of that balance. Now, it's also prorated. So if you start on the 1st of January, you're only going to have a pension for 6 months of the financial year. So therefore, it wouldn't be 4%. In your case, it'd be 2%. So to that end, if you were looking at doing it on
prorated by days or months?
Days.
There you go.
So if you were doing it on 1 April, then it would be 25%. The exception to that is that if you start a pension after the 1st of June, then as in for the last month of the financial year, then you're exempt. But if you did it on the 31st of May, then you would have to do for 31 days, or for 31 divided by 365, that would be the proportionate amount you'd need to take. All of this said, I think you'd be getting, as far as I'm concerned, a little bit too cute with this. It'd be probably a lot more effective for you to just make sure you take a little bit more than 1% down, and then you don't have to worry about the semantics of what the balance was at that precise moment. Ordinarily, we would encourage that this sort of work, like your question around mark to market the value of the SMSF assets, and then also determining what is the specific percentage split between you and your wife at that particular date. This is the domain of an accountant. If you're getting this
SMSF specialist,
yeah, that's right. If you're getting this wrong, then it can have material impacts on and you can have incorrect drawdowns for the next many years to come, which could mean breaches for years to come. So what I would suggest is that instead of drawing down 1% of the value for that financial year, be safe and draw down 2%. Give yourself that extra little bit of breathing room. It's not necessarily going to be the end of the world, or at least 1.5%. Give yourself a bigger buffer so that if your calculation, so that you don't need to know what the precise calculation was on that day, because I got more than enough room up my sleeve. And that way your accountant can likely reconcile all of that at the end of the financial year. Notwithstanding, you'd need to notify your accountant of your intention to set up an accumulation, an
like an application pension. And do around all these paperwork. We usually end up having a set of interim accounts prepared, which is exactly what you're saying, rather than trying to do it yourself. And then when it comes to the pension, I'm always, what's the income you're going to draw per year from this pension? Put the minimum aside. What do you think is achievable and what do you need? And then just start drawing that rather than just worry about the 1 or 4%. And you may be able to contribute if you have a partner. You do have a partner, so contribute in your partner's name any excess if you're drawing more than you need.
Yeah,
I think it's always for us about separating the income and the balance of your super fund from your actual lifestyle requirements, and then rather than letting one leave the other. I think we've done it exceptionally well. Oh, some tough. You definitely got me out of my comfort zone today.
It's always fun, and again, it's always a pleasure having your questions. So thank you so much for sending them through. More to come, and we look forward to chatting to you all very soon. Thank you, everyone.
Good to see you.
Happy Thursday.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.